Hello, and welcome to another episode of Darwin Investors. I'll admit it, I'm an incurable optimist. I do think that what's going on in the market now will eventually pull through it. I do think that a lot of this correction is overdone, but I would like to go ahead and just kind of explain, at least give my take on what I think is happening in the market right now. So let me go ahead and share my screen, and we'll go over the topics of today's show. In today's show, we're going to talk about how the large hedge funds are still profiting. And what they're doing is essentially gambling. The thing about gambling is you may not know, you know you're doing it at first. You know, if you're going to say bet some short-term bearish put options on some overpriced equity, and you know in the long run it's going to go down, but you're not sure how it's going to go over a short period of time. You know you're gambling, you know, in a lot, but if you win like 15 times in a row, you might start thinking you have some kind of angle or something like that. So then you start thinking that maybe you know what you're doing. And the first time you fail, you uh, think, well, okay, that was just once. And you don't start thinking it's gambling until you fail like 15 times in a row, or maybe you only fail 6 times in a row, but in those 6 times, you just managed to lose it all. So a lot of smart people get sucked up in a lot of these hedge fund gambling type of things. And that's what happened to Melvin Capital. And we'll talk about what happened to them. And then I'll talk about how I gambled and what my results were. And again, I was up like 87% 2 years in a row. And I didn't even realize I was gambling. Well, I knew I was gambling for the most part, but then my NVIDIA, I thought maybe that wasn't a gamble, but it turns out it is. And as a matter of fact, everybody's always going to be down on a position somewhere. If you talk to somebody who's never been down on a position, they're lying to you. So stop listening to them. And then finally, we're going to end it on an up note, and it's about the future and how predictable it is and what's going to happen with this market going forward. So let's go ahead and I got this video that I want to show that really details what's happening with large hedge funds.
Here's how we describe this to public companies and investors, that around options expirations, which don't occur on one day, they stretch from this week, Wednesday, Thursday, Friday. New options trade Monday, books get squared Tuesday. So there's a 5-day period where we tell investors and public companies, look, it's like a black hole. You have no idea what's on the other side of what may be tied to your equity. And so number one, it's a bad time to report results. We tell public companies, why do that? It's like trying to give a speech over a leaf blower. The things that will be far more impactful than your story are being reset, recalibrated, bet on during these periods of time, and you will see moves that are extraordinary, or can be, and that are not tied to rational factors. And then what happens is everybody roots around to try to figure out what in the information that a company reported, like Target or Walmart or Cisco, explained a dramatic decline in shareholder value. And it's not that. To me, the principal element that causes this today are exchange-traded funds and pre-market after-hours trading, where only a small part of the audience can trade. I'm against it. I can't fix it, but the fact that big blocks of ETF shares can be created and redeemed off-market by a handful of participants before the rest can participate is a key contributor. So here's what could happen.
Yeah.
This is the key. So say Morgan Stanley is an authorized participant for an ETF complex like BlackRock. And before the market opens, everybody wants out. Hedge funds want out of Target and a basket of consumer staple stocks. And so Morgan Stanley will go around, maybe even borrow a bunch of BlackRock ETF shares and return them to BlackRock and receive in the basket in exchange an equal value of shares, probably heavily weighted to Walmart and Target. Then, because that is not a customer transaction, you can't front run a customer's order, but this is Morgan Stanley operating on its own as an authorized participant, can turn around and buy puts on that whole basket and short the futures, which are expiring. And then all of that volume gets dumped at the open of the market, and these stocks get crushed. And it has nothing to do with rational thought. It is all about market structure. I'm well acquainted with some of the larger hedge funds, and they tell me what they do. And two of the biggest told me that they make 2/3 of their returns on leveraged derivatives bets around earnings. So I might buy, no matter what, I just decide that the bet is going to be short on target. And so then I'm going to borrow 8 to 9 times the money that my options bet is, and just overwhelm the supply side of the market. The stock market is like any market. It's got supply and demand, which are very measurable, by the way. We could see that there was no demand in Target ahead of reports, and its short volume jumped to 62% of its trading volume. So there are two factors that contribute. Exactly the same points you made with your restaurant reservations analogy, that there are things you can't see where there's a great deal more supply than demand, and it could be the reverse when things rise. And then the compounding.
Why is that, Tim? Why is that allowed? Why is that allowed? I mean, I'm all for free markets, but you have these outsized multi-leveraged bets. You're getting retail investors getting their faces ripped off because there's some giant leveraged options bet they've never even heard of.
Well, and there are 3 words that tell you why. And it's from the SEC. The SEC decided that the purpose of the equity market is 3 words: a continuous auction market. Now, some of these things that begin before market hours then have to filter through the system. And here's what I mean by this. So the SEC decreed under Regulation National Market System that there will always be 100 shares of everything at the bid and the offer. Well, it's impossible. So market makers said to the SEC, we can't fulfill that obligation unless you exempt us from Regulation SHO Rule 203B2. Very jargon, weedy term, but what it means, that is the short locate rule. So market makers do not have to locate stock. They just manufacture it. And they will go on, they'll do that in whatever direction the market is moving. That is how Target's volume jumped from 42% short before they reported to 62% short in a day. Market makers will see the imbalance and feed it. If I want to short a stock, they'll manufacture stock to make it available to do that. And that is the problem. It is a flaw in market structure, but everybody should be aware of it. The beginning point.
So to summarize what that guy was saying on CNBC is that basically what's happening is in the pre-market time when none of us can have access to like options and things of that nature, there are certain hedge funds and large brokerage firms that are able to do stuff like that. So in his example, it was an ETF, but just to make it a little bit easier to understand, let's just dilute it down to one single share. Let's say it's Target. And so what he was saying that people would do is that in anticipation of bad earnings, and you could anticipate that Target was going to have some problem, with their margins, knowing that the supply chain and the cost of employment would cost a little bit more. So you can imagine that they're going to have less operating margins and less in price per share. So they were making a bet that Target would dive. And so what they did was they would borrow shares. Notice I didn't say buy. They borrowed shares from a lender in hopes of selling them back to that same lender later on that day. And in case that's called short selling. And then in addition to that, they were also buying puts on the same equity, hoping that it would go down. And so by borrowing these shares, and they don't have to even be real shares, and you don't have to really get them, but by borrowing, you're creating way more supply than demand. And Target is what they call a low beta stock. It doesn't have a ton of demand to begin with. So if you flood it with supply, it's going to drive the price down even more because, supply and demand. The more supply, the less demand, then the price of something goes down. And so what they were hoping for is that the earnings report comes out. It's awful. It's as they expected. And that other brokerages that didn't do the same thing, say Goldman Sachs or JP Morgan or what have you, Merrill Lynch, went ahead and they sold all their shares. So now they're able to, the shares that they borrowed, they've sold all these shares, creating more excess supply, and then they went ahead and sold their shares back at a profit, bought their puts, and then made some money. And that's kind of like what a lot of hedge funds do. They're trying to beat the game. So this is what happened with Melvin Capital. Let me go ahead and share my screen. I'll show you what I'm talking about. So Melvin Capital was the firm that bet against. They were the famous GameStop short seller thing, and they were correct. The problem with it is that these guys don't really know they're gambling. You know, what happens is if you win year after year and trade after trade, you forget you're gambling. You maybe know you're gambling at first, but after a while, you think you maybe have an edge. You're like, well, I can make bearish put options on overpriced equities and make money while they go down, and do this in a short term. And you're going to think that after a while, you're going to believe that you have an edge. And that's what happened to these guys, because they came out of the guns, out of the chute firing. And even like now, they achieved 30% annualized gains year after year. And since they came into being in the year 2014, a lot of hedge funds only last about 3 years. These guys are pretty much high profile because they famously went down here this past week as a result, in large part, to the GameStop short selling fiasco, similar to what I just described earlier with Target. And so they were up 30% year over year. But one investor just understood why Plotkin and his Melvin Capital went down. Is his strategy worked until it didn't. And he came out of the gates firing. In 2014, he was up 46%. In 2020, his last good year, he was up 51.5%. It was the best in a string of banner years. This is how fast it can come down. So this guy for 6 years was way up, 46, he was just way up. And all of a sudden, in 1 year, the GameStop happens, and he watched his fund drop 55% in 1 month. And what would he do? Well, he's gambling but doesn't know it. He says, okay, GameStop is overpriced. I bought these put options. I'm going to buy more. I'm going to just keep rolling them and rolling them and rolling them. I'm going to double down, triple down, quadruple down. There's only one way that this happens is he didn't cut his losses when he should have. Like right at the beginning, he didn't admit that he was wrong in this particular instance because he was convinced he was right and it had worked for 6 years. So why wouldn't, actually 7 years. So why wouldn't you just stick to your guns and maintain the fact that you were right? And that's what happened to this guy. It's just like his strategy just stopped working. And in the end, it sent him right out of business. He did manage to recover down, so he was only down 39% at the end of last year. And by the end of this April, he was down 23% this year, which is 10% at this time of this print, 10 percentage points worse than the S&P 500. But that's totally understandable because a lot of stocks are down 23%. A lot of really good stocks are down 23%. I don't think this was the reason why he went out of business. I think it was more his strategy just stopped working and he just lost confidence. I was gambling and I knew I was gambling in 2020 and 2021, but I wasn't going to allow like some Reddit guy named Big Balls 42069 to outperform me. So I went into a lot of these speculative stocks, just a lot of these high price to sale stocks that I knew was gambling. I'm sure these guys did it as well. A lot of hedge funds have done it, and a lot of them go out of business. A lot of hedge funds only last 3 years and they go out of business. Let me show you some of the trades that I made in the last couple of years that made me plenty of money. Like I went in this Palantir here. If you look at Palantir, I was up $3,800 on this stock. I bought it for 14 back in November of 20. I knew it was gambling. And then I ended up selling it for 24 bucks. This is all before the party stopped. The party stopped for me in February 2021. I'm still doing little bits here and there, but not anymore. Matterport would be another one that I was into. I don't know if I made any money on this one. Let's see here. I made $879 on Matterport. This to me was a dumb company. It still is. We're talking about a company that it takes pictures, like you can link pictures together and then you can create like a little, it's for realtors and stuff like that. Well, they have this thing called a camera that does the same thing a lot better. But I knew it was dumb and I went ahead and bought it anyway because I thought, well, I can make money. I ended up selling it at 29 bucks a share. There's another, my dumbest one. Let me see, HCAC, Hennessy Capital. Okay, here was a company that they made these cars called Canoe, and these cars, you couldn't even buy them. Their business model was that you couldn't buy them. You could only lease them. You could only rent them. You could not have them. So now they're making a product that they haven't even made the product yet. It's unprofitable, not a penny of revenue. And even if they had them, you still can't buy them. You can only rent them. I thought that is the dumbest thing I have ever heard in my life. I will take 1,000 shares, please. Because I was like, let's just see if I can't make any money. I don't even know if I did. Let's see. I lost. So 5,400 was HCAC, and I was down. That's how much I bought in this. And then it eventually turns into Go EB. And let me just see if I made any money on Go EB. So I was spent 5,400 on HCAC. Go EB. Okay, I made $300 on Go EB. That's pretty funny. Let's see what else was there. Oh, there's Bill Foley Trazamine. I don't know. I could go on all day with these. I had lots of them, but I was just way, way, way up. How much did I make on this one? I know I traded this one a lot. Let's see. Down 2,900. In those shares, let me see here, down or up, I don't know, down 7. Okay, that's 20,000 now. So down $20,000, and then it eventually turns into PaySafe. And let me see what I actually made after when I just closed out of this position. So 20,000 down 20. That 28. Okay, I made $8,000 on this one on PaySafe and Bill Foley Trazamine. Really, I could do this for another 15, 20 minutes. I went in on all kinds of crazy stuff that I knew was a bad idea, but I was just gambling and I was just doing it. And that's what a lot of hedge funds were doing. They were like, well, I'm not gonna, I'm getting these phone calls all day long. Why am I getting this phone call saying, well, I'm only up 20%. How come Big Balls Force 2069 is up 99% on my Reddit page and you're only have me up 20%? I don't think you know what you're doing. I'm gonna pull my money out of you and I'm gonna do it myself. So these hedge funds start doing the same exact thing. And so I got roped into it. They got roped into it. And part of what's happened now is I think that what's happened is that, a lot of these funds are having the same problem that I have. Now, it's almost like my life in the stock market the last couple of years is kind of like a microcosm of the hedge funds. And so what's happened is that I've always been like 30, 35% cash. I would go like 65% long equities and then 35% of cash that I could just like get in and out of these trades, get in, get out, get in, get out. But after February 2021, I was only getting into stocks that if I couldn't get out, I didn't mind being stuck in. And so right now I have no cash. And I'm thinking that's the case with a lot of these hedge funds, especially the ones that are going out of business, but they don't have cash either. So when something like Target or Walmart or Cisco or whatever goes right down the tubes, there's no buyers there, or if there is a buyer, they don't have any money left, and they certainly don't want to borrow any in this environment. And so that's what's happening. And why is it gambling, and how does it come back to bite them? Well, look at Microsoft the last two quarters in a row. They had people doing the same thing: sold short, bought puts, sent it right down on immediately. Like, oh, earnings come out. It's like 1 second later, it's down $30 a share. It's like, what? And then you start hearing the conference call come in and they start saying, oh, we beat revenue by 19%. Azure cloud grew by 49% year on year. And all this good news starts coming in. Goldman Sachs gets tuned to this. BlackRock gets a hold of this information. JP Morgan gets a hold of it, says, oh, wow, we should go buy. It's down 30% on this news. Let's go buy. Sends it right back up. The original person that sent it down lost a lot of money. And that's how these people are gambling. But we don't need to do that because investing is simple, as I'm about to show you. So the real reason that the stock market is going down right now, it isn't because it's this huge bear market. It's because the market just needed to correct from really large valuations. It was just too high. 10 times sales used to be the ceiling. In 2020 and 2021, 10 times sales was the floor. Like, we were all buying stuff up at 40 times sales. So the real reason the stock market is coming down, this is printed May 20th, is it's just price to earnings multiple contraction is the main driver of falling share prices. It's that simple. But what's happening is that a lot of these other tech stocks, remember in the original video talking about ETFs, and it's talking about ETFs that were heavy in Target and Walmart, and they were being short sold. Well, these are ETFs heavy in NASDAQ. It's taking down Microsoft and Apple with it. It's taking everything down with it. And so you got to be able to separate the wheat from the chaff and figure out which ones of these companies are going to come back and which ones are not going to come back. And they are going to come back. And I'm going to get up, I'm going to try to close this out in a positive way. There's this guy named Gavin Baker. Gavin Baker is a hedge fund trader. He's the founder of and CIO of Boston-based investment boutiques Atreides Management. And here's an article where he shares his perspective on today's NASDAQ crash, if you will. Mr. Baker, you are one of the few tech investors who lived through the dot-com crash in the year 2000 firsthand and remained active in the sector afterwards. As a battle-hardened industry veteran, how do you assess today's market environment compared back to then? Well, he says, well, here's the big thing. A lot of non-profitable tech companies with under $100 billion market cap just experienced a similar crash in valuations as we saw in 2000. It's the same thing happening now. It happened in 2000. It's a $100 billion market cap rather than a lot less. But from a fundamental perspective, I don't think the burst of the dot-com bubble has many parallels to what's happening today. At that time, after the bubble burst, the fundamentals of every tech company imploded. They missed their earning number by 30, 40, or 50%. Many had significant year-over-year revenue declines, and then their stocks went down more. That's just not happening. As a matter of fact, this earnings season, everybody was like, well, the stocks are going down even though the earnings are okay. It's because we started off with tech and banks, and the banks and the tech are doing just fine. So how are things looking today? Well, I do not believe that the fundamentals are going to crash in a similar way. In the year 2000, nobody knew which business models were going to work on the internet. The build out in telecom equipment, data centers, and software was not based on consumption basis. It was built in anticipation of demand that took much longer than expected to materialize. So back then they were building out in anticipation of demand. Now we have the demand. And so now they have to build out, because if you don't build out, the demand is going to outstrip the supply. Today, you don't see that degree of overbuild or excess on the supply side because it's all sold on a consumption basis. So it's the opposite of what it was in 2020 or 2000. I promise, if the big cloud hyperscalers stop spending on CapEx today, capital expenditures, broadening out their infrastructure, they would run out of capacity in 12 to 18 months. It's a very different environment. I wrote a letter to Kathy Wood. I was like, listen, the term consumer staple is antiquated. If you want to be innovative, the new consumer staple is tech. If I went to my job and I said, I don't no longer want to use Microsoft Word anymore, I want to use something else, they're going to look at me and say, for one, what do you want to use then? Nothing else. There's nothing else out there. I don't want to use Adobe Reader anymore. Can we stop sending these PDFs? Okay, fine. Then what's the alternative? I don't want to use my Apple phone anymore. What's the alternative? Well, there's Samsung. Okay, well, I don't like them either. Well, then I don't know what to tell you. So the new staple is actually tech. Tech is the new staple. I don't like my NVIDIA driver in my computer. I want to use something else. Okay, well, it's tough. You're going to end up using this stuff. And so when do I expect this market is going to turn around? Well, at some point, the market will turn, but it won't be until these winds are shifting. Inflation is coming down and consumers are feeling good about spending money again like they want to and are used to. These are pretty long cycles. So I kind of push back against this just a smidge because it's not going to happen when all that stuff's come down. It's going to come down in anticipation of all that coming down. And so it might be like 6-8 months ahead of schedule. That's kind of the way these things work. But it's one of the reasons why when you tune into a lot of CNBC shows, they want to raise the rates like fast. Just pull off the band-aid. Just raise it a full point if you got to, like right now. Because what this will do, in the short term, it will crash the stock market, and in the long term, it will stabilize things. It stabilizes it because, for one, the market can take, our economy can take some unemployment. I went to a Buffalo Wild Wings last Saturday, and no, 2 Saturdays ago. And it was shut down at 8 o'clock because they had no staff to work there. I went to a Chipotle, and I walked in the place and I had to order on my phone because they had not enough staff to run the register. So these are the sort of things we're going through right now, and it's the reason why Jerome Powell thinks that the unemployment rate, we could get a little bit more unemployment. It's going to help small business. Now, wage inflation is sticky. It's going to actually, like Walmart starts paying a certain amount of money, they can't be paying less in, say, 2 months or whatever. They're going to have to pay the same price. So what they're going to have to do is cut some staff, and some of the staff's going to go work at Buffalo Wild Wings. Some of the staff's going to go work at Chipotle. It's going to help things out in the long in the long run, and then for us stock market investors, it's going to crash everything immediately. But when these companies are able to stabilize their margins and put things back to normal, it's going to help our portfolios in the long run. And that's why a lot of these big investors want this to happen immediately. They know there's going to be short-term pain, but they're only doing it for the long-term gain. All right. And so Warren Buffett, to take the opposite approach of hedge funds, he is he's the polar opposite of a hedge fund. He's a buy and hold guy. He doesn't get whooped up in all these little trends. I'm gonna sell short and buy puts and all that stuff. He likes a company, he buys it. He doesn't buy it. If he likes the price of a good company, he'll take it. And he says that monkeys could do as good a job investing as Wall Street financial advisors. That's probably a little bit degrading. I don't think that's the case unless you fill up the dartboard full of nothing but great stocks. But if you fill up with all of the stocks and you let a monkey take their pick, I have a feeling they'd pick some clunkers. But he says that the investing is a simple game, that financial advisors have convinced the public is harder than it really is. And it is a simple game. If you have a great company and you hold it for a long time, that great company, the price is going to go up. If you have an awful company that doesn't make profits, in the long run, the price is going to go down. It is a simple game. I'll leave it at that. So I do believe the market's going to turn around. I would say that you need to be in these good companies that are being thrown out in these ETF baskets, companies that have no business being thrown out. Don't look for the ones that are 75, 80% down, say like an Etsy or whatever. Go for something that's only like 30% down, something that's just kind of a casualty of war, if you will. And buy into that. If it's a staple, all the better. Like I said, I wrote to Kathy Wood at ARK Invest, and I was like, you need to like get disruptive with this. Disrupt the staples. Target's not a staple. Walmart's not a staple anymore. Coca-Cola's not a staple anymore. The new staple is Microsoft. The new staple is Google. The new staple is Adobe. Apple. These are your staples. These are the things people can't live without and can't work without in today's business environment. Anyway, call it ARK S. That's what I gave her the name for it. Go call it ARK S. Call it ARK Staples and make it all tech and just whatever. And it doesn't have to be all tech, just stuff that people can't live without today. Anyway, if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.